Hi, this is Ken with Online Trading Academy Phoenix. Right now, as a country and as a world, we face a critical juncture. There's a tremendous opportunity in front of us. Those of us who are involved in the markets, there's also a tremendous amount of risk, whether you're involved in the markets or not. What I want to do in the course of this presentation is really lay out what are these risks and what are these opportunities. What conclusions can we draw about what is likely to happen with us and our money, given what's happened historically and what is happening around the world? The presentation is really going to be divided as follows. First, there's going to be a discussion of the near term, which I will define essentially as the first 6 months of 2013. From January to June, again, what can we expect is the likely case of what might happen. Then I want to take a look at the longer term. Really after June, what are the big issues that we need to again focus on if we want to make sure that we not just survive what's coming, but actually that we can thrive and we can prosper during these times. If we look at the first half of this year, there are going to be a series of what I will call manufactured crises, where our government is going to be hitting a variety of spending walls. You've got a debt ceiling debate that's going to resurface. You've got a continuing budget resolution. You've got a situation where we don't know how much money from day to day we're going to be able to spend. And right now the issue is with the sequestration. Now I'll explain all of those issues in more detail, but we have a series again, we're going to go from crisis to crisis to crisis, and that's going to create volatility in the markets. If we look at historically, when we have faced these issues, what has happened, what has been the next step? The most important, I think, predicate is what happened with the debt ceiling debate of August of 2011. Now, for those that aren't familiar with how the debt ceiling works, as a country, we are limited into the amount of money that we can borrow, not by the markets, but by law. And what Congress said at that point was, as a country, we cannot take on more than about $14 trillion in debt. Every time we've come up against these ceilings, basically the Congress rubber stamped it and we increased what the debt ceiling was, and it was no big deal. And people assumed that that was going to happen in August of 2011 as well. But as we got closer to that date, the Republicans were holding firm. What they essentially said was, if we don't come up with an equivalent amount of spending cuts, like if you want to raise the debt ceiling by $2 trillion, we got to see $2 trillion of spending cuts. And as we got closer and closer to this date, it became very apparent that there may not be a deal. Now, if we run out of the ability to borrow as a country, we do run the risk of not being able to pay our bills because essentially 40 cents out of every dollar we spend is really borrowed money. This all of a sudden became a potential crisis. Now, the ultimate solution is we developed what was called sequestration, which I'll talk about in a moment, and an assumption that there would be a huge increase in taxes, but all of these things were going to happen after the election. They were going to be coming on January 1st of 2013. But what we saw in August of 2011, as we moved up to what might be an impasse, was a huge increase in volatility and a huge decline in the stock markets. I will show you those charts in just a few moments. We are headed down this road again, and that's the big takeaway so far. The next is if we look at what happened with the fiscal cliff discussion. Very similar. In this situation, there were two things that were coming up. One, the government was running up against the debt ceiling again. Secondly, all of these tax cuts, again, was affectionately known as the Bush tax cuts, they were going to expire. And we were going to get hit with the sequestration, which was a mandatory cut in government spending. As we were moving up toward this, again, the markets became more volatile. I will show you that again in some charts in just a few moments, but that again is the road we're headed down. So what are, in the first 6 months of this year, what are the equivalents of these two things? The first is on March 1st of 2013, we're going to have the sequestration kick in. Now, when we had the debt ceiling debate of August of 2011, the Republicans said, okay, we're going to let you borrow more money. However, there have to be some forced spending cuts. So what they said is over the next 10 years, we're going to cut $1.1 trillion in spending. They put together a scenario that said, if we can't agree on a smart way of doing this, we're going to do it a stupid way, okay? And that's unfortunately how we work as a country right now. And the stupid way was half the money is going to come from defense and half the money is going to come non-defense, non-entitlement. Now, what does that mean? It means none of the money can come from Social Security, Medicare, or Medicaid, which are a huge portion of the budget. So we're going to focus these cuts to make it very painful for Republicans on the defense side and very painful for Democrats on the social spending side, and that way we will come up with a smarter solution. Well, and this was supposed to kick in January 1st of 2013. When we got to January 1st of 2013, no one had come up with a better idea. So what they said is, okay, let's put this off for 2 months, and so now this has been kicked down the road till March 1st. The other thing that happened is there was a significant tax increase, not just on the rich, but effectively on everyone, because there was a cut in the payroll tax a couple of years ago that essentially was allowed to expire. So everyone's taxes went up that was paying taxes, and that is if you had a job, not even paying income tax, but your Social Security, your Medicare taxes all went up on January 1st. Now, as we were approaching this, and this is being taped in February, people are starting to say the world's going to come to an end. If we don't stop this sequestration, this is going to be horrible. The reality is they're trying to cut $85 billion out of a $3.6 trillion budget. It's meaningless. Okay? It's not going to solve any problems, and quite frankly, it's not going to cause the problems they're saying it's going to cause. But what it's going to do is create volatility. And just keep that in mind, because that's going to be the theme here for the next 6 months. Continuing budget resolution. This country has not had a budget in 4 years. What we have been doing is essentially passing a resolution every year that says, you can keep spending money till we figure this out. This is going to expire on March 27th. If you remember back to 1995, when we had the government shutdown, that was because we lost our continuing budget resolution funding. That is coming up in March. The Republicans again are saying, we are not going to rubber stamp an increase in spending. We are going to have to get serious about the budget. Now also understand this. On sequestration, on the budget resolution, and on the debt ceiling, which hits on May 19th, okay, the Republicans are going to get rolled on all this. The Republicans are going to lose this battle because they're going to get destroyed in the press, okay? However, as each of these things are coming up, they're going to pretend for a period of time that they're going to hold firm on this, and again, that's going to create volatility. And again, that is the big message here, and I'm going to show you why this is important in a second. But the debt ceiling, again, in August of 2011, they reluctantly raised the debt ceiling. We hit that level, the extra $2 trillion that we added in August of 2011, we hit that at the end of 2012. And essentially the way they kicked this can down the road was Congress said, you can spend whatever you want. Assume there's not a debt ceiling up until May 19th of 2013. On that date, you can't borrow any more money unless we authorize that. This is going to be the one that's probably going to put a lot of fear into the markets. Because again, what Obama is saying, and none of this is political, it is my fundamental belief that our political system has failed. Okay? We have created a political problem to which there is not a political solution. But the Obama position is going to be, we just need to raise taxes on the rich, we need to close some loopholes, okay? And the Republicans' view is, we are spending out of control. We have a spending problem, not a revenue problem. And that's going to create an impasse. And as we head toward that impasse, the markets are going to react. And again, I'll show you some charts on what that means in just a moment. Other things that are happening around the world. As of today, the riots are starting in Greece again. I guess it's coming towards spring and it's riot time in Greece. Spain is the big issue. Okay, Spain is in a financially untenable position. Now understand, these things may not hit in the first 6 months of the year, but they might. And you need to be aware of these ideas. What's happening in Greece is fundamentally you have 26% of the people are unemployed. You have 60% of the people under 24 years old are unemployed. You have an economy that there's no possible way they can pay their bills. The people are already tired of this austerity, and they haven't gotten anywhere near what their goals are. By the way, Spain and Italy are going to cause big problems for France, and France has just announced that they can't meet their debt targets. They were supposed to have debt no greater than 3% of GDP. As of a day or so ago, they said we can't possibly meet these targets. So the specter of Europe is also going to be out there in the first half of the year. You may or may not have a crisis here, but if you think about what happened last time, Greece, it was an issue, and all of Europe was an issue. Again, the markets became very volatile. This is something to pay attention to. Unemployment. Without getting into gory detail on this, the Federal Reserve is the only thing keeping this thing alive right now. They are flooding the market with money. Essentially, they are reinflating the housing bubble and they're reinflating the stock market bubble. This means that we also have a dollar bubble and we have a treasuries bubble. And I'll get into all that stuff again. I just want you to understand these big picture ideas for right now, all right? What the Federal Reserve has said is that we're going to basically print money as long as the sun shines and the rivers run until we hit 2.5% inflation or 6.5% unemployment. The basic belief, and this is from the CBO just came out with a report, the general belief is we're still going to have 8% unemployment throughout this year. I actually think that it's going to be significantly lower than that in what's called the headline or the U3 number. What the U3 number doesn't tell you is how many people have given up working and how many people are working part-time that want to work full-time. If you track what's called the U6 number or you track the Gallup number, you get a very different number. So headline number is, right now they tell you 7.8% of the population is unemployed. If you look at the U6 number, what you find out is that 14.4% of the people are either unemployed, they're working part-time, they want to work full-time, or they've just given up. That's the real number to focus on. But here's the thing with the Affordable Care Act, otherwise known as Obamacare. If you have more than 50 employees, if they work more than 30 hours a week, you have to pay for their health insurance. If they work less than 30 hours a week, you don't have to pay the health insurance. People who are on retail, people in restaurants, bars, hotels, places where you don't pay people very high wages because there's not a whole lot of value added being contributed, those people cannot afford to pay a $2,000 or $3,000 fine under Obamacare. So what they're going to do is they're going to cut those people's hours. Now, if I cut somebody's hours, I still have to cover those shifts, at least to some extent. Now, I could just give worse service, which may end up happening, if you can imagine that. But what it means is a lot of people are going to be working part-time. And a lot of people right now that are unemployed are going to be able to get part-time jobs. They're just not going to be able to work more than 30 hours a week. This is the worst of all worlds. The people are going to get no health care. They're going to get fewer hours to work, which means they're going to have less disposable income. And a bunch of people who want to work full-time are going to find nothing but part-time jobs. But what also will happen is the headline unemployment number will start to fall. When that happens, people are going to panic and worry, but if we start getting towards 6.5%, the Federal Reserve is going to stop printing money. If we stop printing money, and that's the only thing holding up the market right now, that is going to cause some significant pain in the markets and, again, a lot of volatility. And in fact, the day that I'm actually taping this, the markets are down significantly because the Federal Reserve is hinting that maybe the quantitative easing isn't going to keep going as long as they thought. If you start seeing unemployment come down, again, because of people working part-time instead of full-time, that is going to get people panicked and thinking the Federal Reserve will pull back. That is going to be a big thing to watch over the next several months as well. One of the other things that's going to be a consequence of this is people are going to say, well, unemployment's going down, we've solved all our problems, and then what we're going to find out is tax receipts won't be as high as they thought, and gross domestic product growth will not be going up. And so they'll be saying, well, how can this happen? And again, it's because the U6 number is actually not changing. So just as a helpful hint, be watching that U6 number, and even better, Gallup releases a poll every month that essentially says, here's the number of people who are between 18 and 65, people who could be in the workforce. How many of them are actually working? Right now, that number is about 40, I think it's 43.4%. That's pretty close, which means that 57% of the people who are between 18 and 65 are not currently in the workforce. And this is going to create a very long-term problem for us. It is the issue of how many people are pulling the cart and how many people are in the cart. And we got to get more people pulling the cart, but I'll get into that. Now, the reality is we can know all this stuff. We can say these items here, the sequestration, the budget resolution, the debt ceiling, all of these things are going to create volatility. If Europe starts getting, going south, the riots come back, all the rest of it, this is all bad. But the reality is there's totally random events out there. A couple weeks ago, North Korea tested a new nuclear weapon, okay? Not the world's biggest deal, quite frankly, in the grand scheme of things, unless they test it in Seoul or they test it in Tokyo. Again, I think there's very low probability, but it's a possibility. If you think about what's happening in the Middle East, things are not going as rosy there as perhaps some people might like to hope. And the reality is this is a world of tremendous uncertainty. There's a lot of potential risk, but risk also gives you opportunity in the markets. And when you take all of this and you put it into this context, I think it is staggering. What this is a measurement of volatility. By looking at the pricing of options, you can discern how much fear there is in the market. And what you find is that right now, and I know this is hard to read on the little screen here, but right now we have the lowest amount of fear in the market that we've had in the last 5 years. Now the market's pretty much at record highs over the last 5 years. The fear is at record lows. With all of the things that are happening in the world, the debt ceiling, the sequestration, the continuing resolution, Europe, all the things we just talked about. Why is it that no one's afraid? That is a really, really important idea. And the reason people aren't afraid is because the market's moving up. But the market's only moving up because essentially we're flooding the market with money. And I'm going to get into that idea. But you also notice on this chart, there's some pretty big spikes where the volatility has come up. This is the 2008 fiscal crisis. Okay, right now we have a volatility index of between 12 and 13, okay? At its peak in this crisis, you were over 90. Okay, that's fear. And there's a general rule, okay? It says when the VIX is high, it's time to buy. When the VIX is low, it's time to go. Right now, folks, we are at 5-year lows. This, in my opinion, is not a time to be taking new long positions in the market. I'll tell you what you can do, but you're not doing that necessarily right now. These, and this candle chart you're looking at, each of these candles is 1 month, but you can see that these things can move very, very quickly. Uncertainty can take over, volatility can take over without a lot of notice. This was the 2011 debt ceiling debate. So as I mentioned earlier, you came into this with everybody thinking, hey, it's no big deal. Every time this comes up, everybody just rolls over, they approve the new increase. It's not something that we need to worry about. All of a sudden it became clear there might be an impasse. You had a huge increase in volatility, a huge increase in uncertainty. With the 3 major uncertain events we have coming up with our budgeting process, and again, when this happened, the S&P downgraded our debt. Moody's has already said, you guys don't really do something about your budget. We're going to cut your debt as well. The reality is we're not going to do anything about our budget. We are not going to significantly come toward balance in our lifetimes until we're forced to. And I will explain why that is in a little bit. If we look at it from another perspective, and we look at the 2011 debt ceiling debate, the market was going up, no one was worried, and this is now a weekly chart. And all of a sudden, when it looked like there might not be a deal, you had the market fall very quickly, and this is a graph of volatility. Volatility increased very quickly. This is why they tell you that when volatility is low, you want to be careful buying, because at some point the fear will come back, okay? When volatility is high, that's the time you want to be getting into the market. That was the opportunity to buy. During this period, in 2 weeks, the S&P fell 21%. The volatility index moved up from 17.5, which is significantly higher even than it is today, all the way up to 48 within 2 weeks. One of the things that you realize is that when volatility is low, options are really cheap. Right now, options are really, really cheap. From my perspective, the right strategy is you buy stuff that's cheap, you sell stuff when it's expensive. Why people are trying to sell options right now make absolutely no sense to me. Those people are going to get set up for a fall. But this is an excellent time to be buying long-term options, both to protect positions as well as for speculation. I'll talk more about that in a little bit. We look at it from another perspective. This is a chart of, if you ask the average, this is the American Association of Individual Investors. Okay, every week they do a survey. And they essentially say, do you think stocks are going to be higher in 6 months, lower in 6 months, or about the same in 6 months? If you subtract the number of people who think it's going to be higher in 6 months from the people who think it's going to be lower, or vice versa, depending which number is bigger, what you find is whenever that differential is more than about 18, not 100% of the time, nothing, by the way, in trading is 100%, but what you find is the market does tend to reverse. Now, in this case, it didn't. Again, it's not 100% of the time. But we went above that threshold on the 23rd of January for the first time in a very long time. We are set up way over here in the corner. Now, does that mean that the market has to fall? No. Does it mean it has to fall in the next 5 minutes? No. This sometimes can go on for months at a time. But the idea is this. If people think the market's going to be higher in 6 months, are they sitting on the sidelines in cash, or are they in the market? And the reality is they're in the market. And you unfortunately run out of people to buy. The highest percentage of bulls there has ever been in the market was March of 2000. That was the month before the market started to collapse because you ran out of buyers. And there's the old story about Joseph Kennedy. Okay, apparently Joseph Kennedy sold all his stocks before the crash of '29. And someone asked him later, how did you know to sell your stocks? He said, well, I was going to work one day, I stopped to get my shoes shined. And the shoe shine guy starts giving me stock tips. He says, so I get to the office and I think about it. I say, if the shoe shine guy's in the market, there's nobody left to buy, okay? And now, right now, there is still cash on the sidelines, but it's coming into this market very, very quickly. And quite frankly, what's happening is a lot of, I'll use this word, a lot of dumb money is coming into the market, not the smart money. And I'll show you that in just a moment here. So what does this tell us? It tells us there's complacency. And what you see at the top of markets is complacency. The AAII, the people who do this survey, did a study of this back in 2004, and one of the key conclusions was, history shows us that more times than not, the market will go against the majority. Right now, there is no fear. People are at very high levels of bullishness. People are plowing money into mutual funds. All of this is a bad sign for the market over the next several months. In fact, if we look at the first week of January of 2013, you had a huge influx of money into the market that week. In fact, you had more money go into the market that week than you've had since March of 2000, which again was the top of the market. The average, and institutions, by the way, do not put money into mutual funds, and these mutual funds are what are called long-only funds. They cannot go short. These are people betting that the market is going to go up. When the average retail person starts plowing into the market, that's usually the time you want to be getting out. Or better, going short or using puts to protect your positions. And again, we'll get into that. If we look at it from this perspective, for the last 2 years, people have essentially been pulling money out of mutual funds. Then, the first week of January, that was the first time there was an uptick in inflows. Now, what's interesting is the market moved up 37% while people were pulling money out. Now, all of a sudden, that people are putting money in, you've already had this huge move up. Let me take a second on this. How professionals make money in the market is they buy at wholesale prices and they sell at retail prices. It's like anything else that you make money on in the world. Why people believe that you should buy stocks when they're at high prices and then try to sell them higher, that only works when there are huge bubbles, like there were in the 1990s. Now, the Federal Reserve is trying to recreate a bubble, and they may be successful for a period of time, but bubbles do always burst. And one of the things that you see is if the market is up 37%, and now this is when people are piling into the market, that's a very bad sign because the average retail person gets in after the move has already been made. And we are coming into a lot of areas that show us there's a lot of risk in this market. If we look at it from this perspective, the people who know more about their companies, the corporate insiders, are they buying or are they selling their own stocks? This is from CNBC in early February, and essentially what you're seeing is corporate buybacks in terms of buying their own stock is at an 8-month low. People do not believe their corporation stocks are undervalued. Also, what you see here is that people, if you look at insiders in companies, are they buying or selling their own stock as a company? That's at an 8-month low. Are those individuals buying or selling their own company stock? They are selling. And in fact, they are selling pretty much at record levels. They are selling 9 shares for every 1 share they are buying. We have very rarely seen that kind of ratio. And if we look historically, are these people pretty good? These people are actually pretty good. This is the S&P 500, okay? And this is the ratio of buyers to sellers. So when the line comes up, what that's telling us is there's a lot of buying going on. So you saw a lot of buying before they made a major move up. Some secondary buying, you made a major move up. Some secondary buying, you had a move up. This is where we are today. In this chart, there's only been one time, which was back in here, and we didn't see a big drop. We saw some drop. But we are at record lows in terms of optimism among corporate insiders. And again, these are people who know more about their companies than anybody else. So what does any of this mean? What it means is there's all this uncertainty out there, okay, but there's no fear. The average retail guy is piling into the market, but the smart money is getting out. That is setting up for a very dangerous position for the average retail trader who's now jumping back into this market. Does it mean the market cannot go higher? No, it doesn't mean that. Bubbles can last very long times, but ultimately there's some people heading for a whooping, and this is the time to be protecting yourself. And again, we'll talk about how in a little bit here. Put it into this context. These little yellow areas, if you can see those, what this shows us is when we've had the largest inflows into mutual funds in history. Historically, more money went into mutual funds in the period between January and March of 2000 than any other time. And in fact, the single biggest month was February of 2000. From this point, and it didn't happen right away, it took several months. Each of these candles is 1 month. But from here, the market did have a big correction. It dropped about 53%. The third largest in history was right here. The market only fell 8%. It was not a big deal. And again, nothing in investing is 100%. This is the second largest. From here, the market fell 61%. So what again is happening is Joe Bag of Donuts and all his buddies are jumping into the market at the absolute top. What you now find is in January of 2013, this is actually the largest it's ever been. This is the only time now that's been larger than February of 2000. So what's happening is there's no fear. The corporate guys are getting out, the retail guys are getting in, and they're getting in a bigger way than any time in history. That does not bode well for the market over the next 6 months. Now again, can this go on until June? Sure it can. But if you think about it as a trader, if options are cheap and you can use options to protect positions, now's the time to be buying them. If you can use them for speculation, and you can do both of these things, and again we'll get into how to do these things, now's the time to be buying options, not the time to be selling options. We meet people all the time saying, you know, Joe, I'm selling these options, I can't make any money. Yeah, because there's no fear. You make money selling options when there's fear, you make money buying options when there's not fear. And this is the time, again, when there is no fear. We look at it also from this perspective. What you see is this is really the all-time high in the market back in 2000, 2001. And this is the S&P 500. Again, this is a monthly chart. There is a huge area of selling that we identified back in 2009, and the market has moved right back up into that area. Again, does that mean the market has to decline? No. But if you look at probabilities, and something I've been saying on our radio show for many, many months now, is the market is trying to go higher, and the market wants to go higher because, again, all this retail money is coming in. But it's getting harder and harder for it to move higher. The moves are smaller and smaller. And part of it is because we've moved into this area where there was extreme selling. What again does this tell me? It tells me that I would not be just jumping into a bunch of long positions without buying puts to protect myself. Let me just take a second on this. What does it mean to buy puts for protection? All a put is, and it's a kind of option, it's an insurance policy. It's the right, but not the obligation to sell a stock, or it can be real estate, it can be an index, it can be a lot of different things at a certain price for a period of time. What it does is it guarantees you that you're not going to lose more than whatever you're willing to risk. This is the time to be buying those options, and I would be buying ones, and again, I'm not giving you investment advice here, but think this through. Buy yourself a couple years of protection right now. Do we think that sometime in the next 6 to 12 months that the market could take a big hit? I personally believe that is the more likely than less likely case. Big hit is that 10 or 20%? No, that's like 40%. Okay, I think it's a big, big hit. One of the hardest things with options is you don't really know the time frame. You know ultimately what has to happen. So always buy yourself a lot more time than you think you need. If you go out right now, 2-year options are very, very cheap because, again, there is no fear. And this is the time that you want to be locking in that protection over the long term, and it's like buying insurance on your house. And if I said to you this, do you think it's more likely that your house is going to burn to the ground or that stocks are going to fall 20 to 40%? I think it's more likely stocks fall 20 to 40%. You've got insurance protecting your house. Why aren't you protecting your portfolio? Because there's complacency. Because people think, well, the market's only going to go up. When that happens, the herd is almost always wrong. Don't be on the wrong side of that trade. Get your protection now, and you can also buy those puts that will make money when the market falls. You can use them also to profit, not just protection. So if we wrap up kind of the next 6 months, what do we see? There's a lot of risks out there on the near-term horizon, and there is no fear in the market. Again, what are the specifics? We want to look at the continuing resolution debate, the sequestration, and the debt ceiling debate. The things that are happening in Europe. All of this is out there, and again, there's absolutely no fear in this market. This, from my perspective, is the ideal time to be buying long-term puts. Not calls, but puts that make money when the market goes down, that protect you when the market goes down. They're cheap. Okay, get yourself some cheap insurance. Don't wait until the hurricane strikes before you start trying to buy the hurricane insurance. Again, not a good time to be selling options. There's no juice. There's no money in it. I think that you're looking at a major increase in volatility and a move down sometime in the first half of the year. Is it guaranteed? No. When I say it's very possible, I give it 60, 65%. Okay, there's no certainty in trading. But are you willing to risk everything that you own that this isn't going to happen? I think that's foolish. Okay, I think that is something that then you're not investing, you're gambling. This is the time to be cautious. This is the time, as they say, be greedy when others are fearful and be fearful when others are greedy. People are getting very, very greedy. I would be more concerned.